I'm joined here in the AFA head office with Angela and Lisa, who are going to be assisting this morning with identifying questions and putting those questions to me as we work through the presentation. I very much appreciate you joining for today. There is no doubt that this has been a very eventful year. We have had, right from the start of the year, so much going on, and it's continued all the way through to the end. We still have major things happening now in this in December. What we're going to do today is we're going to focus on a lot of the key things. We clearly can't cover everything, but we will have a copy of the webinar available for members to read afterwards, and also we are recording this, so there will be a video as well that will be published. So I might now get started. So it has been an incredibly challenging year for the advisor population right across the country. There has been so much happening, and I'm very conscious of the impact that this has had on our members and the broader advisor population. There have been some suggestions that the AFA has been inactive. Well, let me just set out some of the things that we've done over the course of this year. 50 submissions, 76 meetings with politicians, 39 meetings with regulators, including one this morning, 13 policy-related media announcements, and 11 thought leadership papers where we have tried to influence the debate and the discussion in the Australian financial advisor population. Some of those papers, and I'm not going to go through all of these because we have a lot to get through today, but we've had a lot to say with respect to the Royal Commission, the mistakes in the Royal Commission, the lack of debate, the processes that the government's worked through, issues with respect to FASEA, and most recently, the lack of recognition of prior learning and experience that applies to many existing advisors. You'll find all of these papers on our webpage, on either the Royal Commission or the FASEA page. I fully encourage you to have a good Christmas break. However, if this is what will interest you over Christmas, then please have a look at some of these articles that do provide a lot of detailed description of the issues in play in financial advice. Now, I might start with a little bit of industry dynamics. A couple of interesting slides here from investment trends. The one on the left is simply showing that the number of active clients has been progressively declining. The number of total clients, which includes passive clients, has also declined significantly. You can see the scale of that decline over the last 10 years. But what we're expecting to see as grandfathered commissions disappear over the next 12 to 13 months is that number of passive clients is likely to decline even further. The slide on the right is showing in many ways the change in business confidence and the mood. From 2014, when 72% of practices had a more profitable year, in 2019, we're seeing for the first time the number of practices with a less profitable year is now greater than those with a more profitable year. So that really reflects what we're seeing in the business and the mood around the advisor population. I've used this slide at our conference this year and more recently simply to try and get on the one page all of the things that are challenging the advisor population. So on the left, we've got all of the FASEA changes. On the right, we've got the Royal Commission developments, whether that's grandfathered commissions, annual renewal. We've got the life insurance commissions issue tied to the life insurance framework, closure of large institutions, ASIC projects, some of which we're going to talk about today. Now, I think one other key structural change that we've seen in the marketplace over the last 4 years is the reduction in the number of advisors who are authorised by the large institutions. This shows the change from May 2015 to November 2019, which has seen such a significant reduction, more than 5,000 reduction, so more than 4,000 reduction in the number of advisors in those large 5 institutions. Back in May 2015, the Financial Advisor Register was very new. It started in March of 2015. And it's interesting to see that back in those days, it looks like not everyone had got onto the Financial Advisor Register. We had only 1,200 advice licensees. That's increased to 22,000, so 2,255. Now, I think it's in part that, yes, there's been a transition to smaller licensees, but it also probably reflects the fact that in May 2015, many of those small licensees probably hadn't got their advisors on the Financial Advisor Register. We've seen the total number of advisors decline from nearly 29,000 at the start of the year after the big rush to get on the register to be an existing advisor, to now down to little more than 25,000. And obviously we expect to see that decline further. I think at the core of what we're facing at the moment is a really big issue about the future of financial advice. We've seen so much change with such a big impact on the profession, on the cost of providing advice, and in combination with concerns around future income, we're now at a point where we're particularly concerned about the access and affordability of financial advice for everyday Australians. This has to be one of the big advocacy points that we take forward with the government and with the regulators next year, ensuring that financial advice remains available for everyday Australians. Today, what I'm going to cover is a few key issues that I think are most relevant right now. An update on recognition of experience for existing advisors. Obviously, the Code of Ethics is something that is really important and is very much what we're facing at the moment. I'm going to cover that in detail. Grandfathered commissions is a battle that we fought this year and we've lost, but it's important that people understand how that's going to play out. The next big thing is the recommendation from the Royal Commission on annual renewal and payment. I'm going to take you through the detail of that and reflect on some of our thinking. Earlier this week, we had a really important announcement by APRA with respect to income protection insurance. I'm going to talk to you a little bit about the life insurance market, the changes we've seen there, and the pressure that is in play in that market. ASIC last week released a report on FDS as an opt-in, and I'll take you through the outcome of that and some things for practices to think about. And ultimately, we do need to reflect upon how the advisor community is travelling. I want to talk to you about recognising that and the help that's available. So let's get into FASEA. A few recent developments over the last few months. We're very pleased on the 30th of August when the government announced that they are going to move forward with extensions for the deadline for the exam and the education standards. It's really important to note, however, that those changes have not been implemented, and we need to continue to work with the government and other political parties to ensure that those changes are enacted, are legislated in the early part of next year, because we want certainty on the extension for the exam as soon as we possibly can. On the 11th of October, the government made the decision not to continue with code monitoring bodies because they intend to move forward more rapidly with the Royal Commission recommendation around a single central disciplinary body. Then on the 18th of October, FASEA released the Code of Ethics guidance, and I'm obviously going to talk to that in some detail. On the 22nd of October, the AFA submitted our application for approval of the mentor version of the FCHFP and the Chartered Life Practitioner. That was an important development. A lot of work went into that, and obviously many of our members have been very anxious to make sure that progressed and it achieved a good outcome. We're expecting to know probably by early next year but we remain confident that that will get through. And also on the 13th of November, in our weekly update, we brought members' attention to the fact that we have now negotiated discounts for the graduate diploma and bridging courses with 4 education providers. So we've got Deakin, University of New England, TAFE New South Wales and Kaplan. So we encourage members to have a look at that and consider what courses they intend to take. So yes, the announcement on the 30th of August, the last day of our conference in Adelaide, we're very pleased when we finally got news of that decision. It had been something that we had been working with the government for some time. Many of you may have seen the video of the first appearance of FASEA at Senate Estimates, where not only Amanda Stoker, but there were other questions also raised of FASEA. Amanda Stoker certainly pushed the issue of recognition for experience, seeking an answer from FASEA as to why where they've currently landed does not adequately consider CPD or prior learning courses that have been undertaken from advisors, particularly those who might have started in the profession much earlier on. Amanda Stoker presented at an AFA event a week after her appearance at the Senate Estimates, and she was certainly very warmly welcomed at that event. The AFA has also most recently produced a paper that got very broad coverage in the trade media, comparing the FASEA outcome with what the explanatory memorandum spoke about, and highlighted the fact that things like CPD and prior diploma courses have not been recognised. So to conclude with respect to FASEA, we are continuing to push for recognition of experience, and that's recognising CPD and other previous courses that many advisors have undertaken. We want greater flexibility in the courses that need to be undertaken to better support specialists. A specialist does not want to go back and do all of the training that's currently in the graduate diploma. They want the opportunity to study in areas that really focus on their specialist area. We're going to talk about the Code of Ethics, but certainly we are looking for some pragmatic changes to that to make it much more workable. I've already talked about the extension to the deadline, but until that's legislated, that has to stay part of our discussion with government and other politicians. All right, let's talk about the Code of Ethics. We have 5 values and 12 standards. But I want to just start by a little bit of context around the legislation on this standing of what this means for the advisor population. It is a little bit technical, but there's not a lot of detail here. Section 921E basically says financial advisors must comply with the Code of Ethics. So it is in the law that you must comply with the Code of Ethics. Section 921U talks about the functions of the standards body, which we now know as FASEA. And this highlights the fact that FASEA has to make a Code of Ethics for the purposes of Section 921E. That's the basic law. 922HD is an obligation on code monitoring bodies to report failures to comply with the Code of Ethics to ASIC. However, we don't have code monitoring bodies. The government chose back in October to discontinue that part of the professional standards regime, so there will be no one playing a role of reporting failures to comply with the Code of Ethics to ASIC. And finally, 1546F is with respect to transition arrangements, and this simply states that the Code of Ethics will start on the 1st of January next year. That has not changed. So we go looking into the explanatory memorandum to say, well, what guidance did the Parliament provide to FASEA in terms of building a Code of Ethics? And there is very little detail in there. So it simply says the code sets out the ethical obligations that apply to relevant providers. These ethical obligations go above the legal requirements in the law and are designed to encourage higher standards of behaviour. Now, it's our view that in terms of setting the code, it was expected that it would be at a higher level than the legal requirements, but not to go so far as to actually rewrite the law and introduce what is in effect new law. So the Code of Ethics was released on the 11th of February this year, the legislative instrument and the explanatory statement. Now, buried in that was a statement that additional guidance, a guidance document that includes case studies for each standard will be released shortly. That was the 11th of February. Shortly afterwards, on the 18th of October, we did get the guidance. A 40-page document with 32 examples that went across each of the 12 standards. Now, it's fair to say that there's been a very strong response, but I want to firstly take you back to the media release on the 18th of October. In the third paragraph of this media release, it made the point, the making of the code and changes to education and training standards reflect community expectations that the provision of professional advice be centred on serving the best interests of the client, free from any conflict. Now, we have no issue about it being centred around serving the best interests of clients, but we're certainly not sure that there is any community expectation that it must be free from any conflict. And I'll talk more about conflicts in a moment. So we didn't hold back. We were very clear in our views on the guidance. We had certainly been led to believe that the guidance would clear up much of the uncertainty that was created by the release of the code in February. In our view, the guidance actually made things more complicated and more uncertain. And I'll talk through that in just a moment. So yes, it is important that we understand the implications of the code. We do have concerns in a number of areas. We are concerned about scaled advice. With some of the expectations about broader circumstances, likely future circumstances, the obvious need to more deeply understand a client's situation, what impact might that have on scaled advice, and what impact might it have on the ability to provide cost-effective financial advice to those who have lower needs and reduced capacity to pay. Standard 3 is what we believe, based upon a clear understanding of what a conflict of interest is, our view is Standard 3 is unworkable and needs to be changed. We don't know that a solution around a reduced focus on this or a facility of compliance approach is going to solve the problem. We still think this is a standard that needs to be changed. Referral arrangements, FASEA have been very blunt in their expectations around referral arrangements, and this is an important issue for many practices who have a high reliance upon the receipt of referrals, and even reciprocal referral arrangements with other professionals seem to be challenged here. There are implications for being able to recommend a company or the products of a company that you personally hold shares in. We also have concerns around definitional issues, like what does fair and reasonable mean, and what's value for money for the client. This is part of Standard 7, and it's probably why we've got the updated intervention, I guess, by ASIC in terms of a facility of compliance period. We also had concerns around Standard 4 and 7, talking about the need for existing clients to provide consent. So let's go back and talk about conflicts of interest. There is a core obligation in the Corporations Act. Section 912A is the core obligations that apply to licensees. And it states that licensees must have in place adequate arrangements for the management of conflicts of interest. Now, the important point here is it is the management of conflicts of interest. It is not the entire avoidance of conflicts of interest. ASIC have a regulatory guide, 181, that discusses the obligations for licensees with respect to the management of conflicts. That talks about controlling, avoiding, disclosing. It simply doesn't say you need to entirely avoid conflicts. The guidance document then on page 17 went into some particular issues that open up more questions. So there's a discussion there about ancillary products. But our concern is, what is an ancillary product? What does it mean that it's merely incidental to the advisor's dominant purpose? And then that second bullet point seems to imply that you need to be offering the best option, not that you need to provide advice that puts the client in a better position. And then there's been obviously great level of discussion around this next paragraph, other sources of variable income. And it talks about a disinterested person might reasonably conclude that the form of variable income could induce an advisor to act in a manner inconsistent with the best interests of the client. And the inclusion of references to brokerage fees is obviously of great concern to stockbrokers, asset-based fees, which were never mentioned in February with the release of the Code of Ethics, and commissions, which is obviously a really important part of the income that's derived from life insurance advice. So this particular sentence created all sorts of uncertainty. FASEA have said that the code doesn't ban any particular form of remuneration, but it's difficult to see that with the simple basic wording of needing to avoid all conflicts. So examples of conflict. We've obviously talked about brokerage commissions or asset-based fees where the amount of remuneration is directly related to the recommendations and the scale, whether it's the amount of shares purchased, it's the level of insurance cover, or it's the amount of investment that's covered under asset-based fees. If you personally own shares in a particular listed company, does that mean you can't recommend that company? Does it mean that you can't recommend shares that are, products that are produced by that company? What about situations where you have a friend or a family that works for a financial services company that you might recommend products from? We've obviously got what we have long understood, the issues with respect to vertical integration and recommending products or services from a company that you work for or are authorised by. Referrals to associated companies. Many advisors run associated businesses, whether that's an accounting business, an administration business. It could also be a mortgage broking business. Referrals on a reciprocal arrangement basis. This is a really important service that you provide to your clients. You've identified other professionals, whether that's estate planning lawyers or it's accountants, where you believe they can provide a good service and they don't need to go through the process of considering all the different options that may be available to them. What about in small towns where you've got one accountant, one financial advisor, one lawyer? You can't, as FASEA seems to have suggested, offer a suite of recommendations. And it even goes back to consideration of training that you might receive from product providers or other non-monetary benefits. Are these conflicts that you would necessarily need to avoid? Right, so back in October, the government announced that they were not going to continue with the code monitoring solution that had been part of the legislation, and obviously the associations had been working together to build a code monitoring body. But at that time, they made it clear that the code would stay and that licensees would have a responsibility ensuring compliance with the code. We've obviously been very active in lobbying the government and, for that matter, FASEA and ASIC about the impracticality of the commencement of the code from the 1st of January. So as a result, we had the important announcement last Tuesday from ASIC with respect to their approach to the code. And there's a few key points in here. ASIC will not be monitoring or enforcing individual advisors' compliance with the code. Neither do they believe they have the power to ban advisors for breaches of the code. So ASIC is making a very clear point here that this is not something that they will place a high focus on. They will expect licensees to be making reasonable efforts. They also then went to talk about their approach with respect to standards 3 and 7 of the code, talking about how they are going to take a facility of compliance approach. Now, many people are probably asking, what does a facility of compliance approach mean? I think it's necessary to view this in the totality of their announcement, which is that they are not going to be intervening. They do expect reasonable efforts to be taken to comply, but they are cognizant of the fact that consultation is ongoing, and certainly with respect to standards 3 and 7, they think that there's a lot more work that needs to be done. We also had AFCA come out last Friday and make another announcement with respect to their approach. They referred to ASIC's announcement with their facility of compliance approach. We are very conscious that even if ASIC is not taking any further action, the code could still be binding on advisors with respect to actions taken at AFCA or actions in the court. And that's why it is really important that we get a permanent solution here and not just a facility of compliance approach. So let's go back to it. What does this mean that you should do? And it is very difficult because we don't have a perfect solution. We're certainly appreciative of what ASIC and AFCA did last week, but we don't believe we have a complete solution. So what we recommend is you do take on board the announcement of ASIC. Read that announcement, understand what they have said. It is important because I think that this is very much part of the message for the industry, and it's something that I just want to take you through. Consultation is ongoing. Any expectation of changes to business practices by the 1st of January are unrealistic and unreasonable. There is still a high level of uncertainty. FASEA have promised to issue further guidance before Christmas. So we would say be very careful about considering making important decisions at this point in time. There is a fairly clear message that you are not expected to do anything with respect to standards 3 and 7 at this point in time. We do say, however, though, it is very important that you do understand the code and that you have given consideration to what that might mean for how you run your business and whether there is a need for any change. So as clearly as I can try and be, what I'm saying is that you're not expected to make fundamental changes to things like referral arrangements or the receipt of asset-based fees or life insurance commissions from the 1st of January. This process is still in place, and we certainly hope to have a more sensible outcome in the short term. Let's now move on to the Royal Commission. The picture on the left is Kenneth Hayne at his angriest. The picture on the right is a picture that clearly suggests that he probably didn't want to be in the same room at that time. The government came out on the 19th of August and announced their implementation timeframe. Now, grandfathered commissions, they said, would be finalised by the end of this year, and we saw that come to fruition in October. In June of next year, annual renewal is the biggest priority. This is something that we are working on now. We'll also see disclosure of lack of independence. And at the bottom there, no advice fees to be paid from my super accounts. It was one of the recommendations that we just fundamentally cannot agree with. Why should members of super funds who only have a My Super account be prevented from accessing financial advice or be forced to pay their fees out of their bank account. We then move on to December of next year. Two key parts of that is the new disciplinary system and compensation schemes of last resort. In 2021, ASIC is going to be undertaking their review of life insurance advice, and we will know more about that in the first part of next year. The review will go for much of the year. ASIC have indicated that they will not be releasing the report until 2022. So we have a little bit of time to play out there, but it remains a really important focus area for us. And then in 2022, some of the recommendations were around further reviews of the quality of financial advice and further consideration of conflicted remuneration exemptions. So those timetables are the timetables for the completion of consultation and the introduction of legislation to the Parliament. Let me quickly talk about grandfathered commissions. We have had a lot to say over the course of this year on the grandfathered commissions debate, and we're very conscious that across our membership base, for some people, this is an issue of let's just move on. For others, this is a really critical issue and it will have a significant impact upon their business. And it's about the fairness of the process and the adequacy of the process. So in this slide, I'm highlighting a few things. And ASIC made it clear in a recent PJC that they have not yet done the work to fully understand the impact of the ban on grandfathered commissions. Nobody really seems to know how many clients will be impacted. The government did not do a regulation impact statement. They have still not released submissions that they received in response to the draft legislation that was issued in February of this year. Clients will be negatively impacted, and there are still no measures to ensure that those clients are not worse off. There is still no guidance on what financial advisors need to do. In our view, this has been poorly conducted legislative change, and we'll wait and see what happens next year, but there will be clients who are disadvantaged as a result. There's also a lack of understanding of the implications of it. The diagram on the left shows the current state, shows that shelf space fees paid from fund managers to platforms, trail commissions flow through to advisors, volume bonuses from platforms to licensees, and they may also be passed on to advisors and clients. But what is not well understood is that when it comes to shelf space fees and volume bonuses, they have been paid with respect to clients on advisor service fee arrangements before the commencement of FOFA and also the first 12 months of the FOFA regime. So clients who were signed up in the period up to the 1st of July 2014, despite the fact that they're on an advisor service fee arrangement, may be entitled to a shelf space fee rebate and a volume bonus rebate. So this is going to be a lot more complex than anyone has ever suggested, and it will impact your advisor service fee clients. We did a little bit of a flowchart a few months back just to go through the decision-making process that advisors would need to work through as they considered the right outcome for each of their grandfathered commission clients. I'm not going to talk through that right now. That is on our website, and it is something that we highly encourage impact advisors to be working on now, is how do you find a solution for each of your grandfathered commissions clients. Now, I just want to include this slide. This is recent work by Investment Trends that shows the amount of practice income that relates to grandfathered commissions. It is 6% of total practice income. Now, obviously, a large number of advisors have no grandfathered commissions left, particularly newer advisors and those who transition to advisor service fee arrangements more early on. But there are many practices for which grandfather commissions remain a significant part of their income. So a huge focus of the Parliament for just 6% of practice income. This slide is also interesting to demonstrate the amount of revenue that's life insurance based, 23%, and also fee-for-service asset based, which is 28%. And also we see an increasing focus on fixed fees. On the 13th of September, Bert van Manen from the Liberal Party, the seat of Ford in Queensland, asked some probing questions of ASIC at a Parliamentary Joint Committee on Corporations and Financial Services. We have included a link to that in our weekly newsletter at the time. But Bert asked a range of questions of ASIC, including with respect to the extent to which they had done the work to understand the impact of banning grandfathered commissions, and also why they had not disclosed in their submission to the Royal Commission the complexity and potential negative consequences as a result of the removal of grandfathered commissions. ASIC's answer on the day was that they had ran out of pages in their submission, and Money Management ran an article on that. But it's interesting to reflect on the instructions from the Royal Commissioner. They had a page limit of 35. They only used 32 of those 35 pages. Let's now move on to annual renewal. This, I think, is going to be the big issue in the first half of next year. The government has said that they want to consult on this and introduce legislation by the 30th of June next year. Now, we've seen from the previous slide that whether it's asset-based fees or it's a fixed fee, advisor service fee arrangements make up a very sizable proportion of total practice income. So the recommendation from the Royal Commission on annual renewal and payment, the law should be amended to provide that ongoing fee arrangements must be renewed annually by the client, must record in writing each year the services that the client will be entitled to receive and the total of the fees that are to be charged. So that's new. So an opt-in would need to predict or estimate the fees to be charged over the next year. But the third part of it is that the product providers would need to obtain authorisation from the client. Now, we have a view, very strong view, about how they might go about doing that. So that was the recommendation released on the 4th of February. On the 10th of April, APRA and ASIC came out with a letter to super fund trustees, where they spoke about the importance of super trustees taking appropriate oversight measures to ensure that fees that were paid out of super accounts to financial advisors were appropriate. In that letter, they talked about a few things. Key amongst them was that best practice was to obtain authorisation from the client, that trustees should make sure that services, agreed services, have been provided, and that they should not place undue reliance upon the attestation or assurances of financial advisors. We have been active in talking with both APRA and ASIC about our concerns with that, because we do not think it is appropriate that trustees go directly to clients for authorisation independent of the financial advisor, because that duplicates the process that clients need to go through, having them need to sign authorisation for the advisor and the product provider just does not make sense. And we've also highlighted the fact that trustees do not know what services you have committed to provide to your clients, so how can they actually check that they are being provided? We are in the process of working on a recommendation in response to this proposal. Now, the government is committed to implementing the Royal Commission recommendations, so we shouldn't assume that anything other than annual renewal is going to be possible except in certain circumstances, and I'll come to that. We have suggested that it is necessary to retain the FDS model, and we've accepted that opt-in should be extended to pre-FOFA clients. who at this stage are not required to opt in. We have suggested, though, that FDS and opt-in should be disconnected. At the moment, it is mandatory to provide an FDS every time you do opt-in, and that complicates things in terms of timing and makes it much, much more difficult. We've said that changes need to be made to avoid having different dates, to have an opt-in date and an FDS date. What we've proposed is that there should be a solution where advisors have an opportunity to get the client to renew at any point between the 8-month mark and the 16-month mark. That provides the flexibility so that if clients are away, if clients are unwell, that they will still have a chance to renew before the arrangement would be terminated. The renewal date would stay the same. It would apply each year. You just have greater flexibility to complete that renewal process. We're saying that client approval should only need to be provided to the product providers every 3 years. Doing it every year is simply unnecessary, particularly if the clients are signing those renewals directly with the advisor. We're also looking for a solution for clients who have reduced advice needs and reduced capacity to pay. So we're talking about an option that might be a capped fixed fee option for these clients that would allow them to renew every 2nd year. We also appreciate that there are related issues with respect to the expectations of ASIC to provide reviews and when those reviews need to take place. So we're calling for more flexibility in those arrangements. Very quickly, diagrammatically here, we're using an example saying if someone started a new arrangement on the 1st of December 2020, they would have a renewal date 1st of December 2021 with an FDS due by the 30th of June 2022, but the advisor should be able to sign the client up at any stage between August and the 1st of April 2022. So there's much greater flexibility. The renewal date doesn't change as you go into the 2nd year, but once again, there's that greater flexibility to obtain the client's consent. We will produce a paper that we will share with members next week, and we'll very much look forward to your feedback on this. This is going to be a very important change next year. We shouldn't be unrealistic that the government is going to step away from this. We need to just leverage this opportunity to come up with a range of ways of improving the current process. Now, is it worthwhile covering any questions at this point? Sorry to put Ange and Lisa on the spot.
Yes, we believe so, Phil. We've got a nice starting document. We've got to get you on that. Yep. So why have an FDS and an opt-in is one from Worll?
Yeah, so that's a good question. And what our proposal is designed to do is to disconnect the two so that you don't need to provide the FDS at the same time as you do opt-in, and you've got much greater flexibility in when you get them to opt-in. So I think the intent of FDS is clients know exactly what they've paid, and that's probably reasonable. And we've got to be realistic about this in the context of the scandal around fees for no service. However you want to read that, that has been a very big factor in the Royal Commission and a very big factor in the government's response. So it's going to be difficult to walk away from some of those consumer protections that are there now, or what is intended to be a consumer protection. We have to find a workable solution that delivers the same outcome, but is much more efficient and flexible for advisors. Any other questions at this stage? Because we can cover them at the end.
Yeah, we've got someone on Code of Ethics.
Right.
So Adam would like to know, is the relevant provider the advisor or the business, i.e. the car,
And does the code apply to the individual advisors or their employer, or both?
Okay, so very good question. The code only applies to the relevant provider, which is in large part the individual. In limited cases, robo-advice, it might be the licensee. But for all effective purposes, the code applies to the individual advisor. It does not apply to the licensee in a strict sense. Licensees are required to take reasonable steps to ensure that their advisors are complying with the code. This does open up a range of questions around if benefits are paid to the licensee, then does it impact the advisor? And I think this is an interesting thing for us to consider, but I don't think it's something that will deliver a solution. I think we need to make sure that the code is workable at the advisor level, the car level, and the licensee level.
So we've got another question here around the same, something similar. If AFSLs are being charged with babysitting code compliance, how can they qualify as a disinterested party, given they are responsible for the conduct of an AR?
Okay, so let's go back to that that discussion of a disinterested person. That is not a reference to a licensee. That is a reference to someone removed from the particular situation. It's a very legalistic way of talking about how a particular situation would be assessed. So it's a disinterested person would reasonably conclude that the advice may have been or could have been influenced by the conflict of interest. Now, so that's more a test for a court or a test for AFCA than it is a test for licensees.
And we've got another one here around referral arrangements from Daryl. So other professionals like lawyers and accountants can have referral arrangements and advisors now can't. Why is this so?
If you've read the paper that we produced on the Code of Ethics, we've done one that we call the Impossible Puzzle. That's on our website. Strongly encourage you to read that. Also on our website is the submission that we provided to FASEA on the 22nd of November. We are totally uncomfortable with the position on referrals, and it seems to be that FASEA have a problem with the being paid to provide referrals to other people as much as they do paying other professionals to receive referrals. We cannot see why this is to the detriment of clients. We've pointed out that accountants can refer and continue to refer clients to advisors. Lawyers also have referral arrangements. There is no logical answer, and we simply do not accept that a blanket ban on referrals should be the outcome here. I can't answer that any more clearly than that. We strongly oppose the position FASEA have taken on referrals.
Maybe we can squeeze one more in from Matthew. Do life insurance trails get caught under standard 4 and 7?
Good question. So that's a question, I think, around the requirement to obtain consent for the continuation of an arrangement or the continuation of a remuneration arrangement or remuneration payment. We have gone to FASEA to say that this should not apply to grandfather commission clients or to life insurance only clients. There's a range of reasons for that. Life insurance only clients is specifically excluded from the definition of an ongoing fee arrangement. Plus, clients have already consented. When they signed the SOA, when they applied for the product, they have already consented. And the guidance hasn't addressed this issue, but it's been part of our feedback back to FASEA is you need to address this issue. Our position is very clear. Should not apply to life insurance only clients, and equally with advisor service fee clients, if they've previously signed an SOA, then it shouldn't apply to them. They have already provided consent. All right, so we might keep moving on. Life insurance. I do want to cover a few issues in life insurance. I'll just quickly provide a little bit of context. The investment trends research show that the percentage of practice income obtained from life insurance is gradually declining. At the moment, it's just under 0.25%. Those who are risk specialists, i.e. more than 50% of their remuneration is from risk, has also continued to decline, which is down now to around 15%. So the life insurance market has been one that has been subject to significant change. Just looking at the overall market, and it's important to understand the size of the life insurance market in Australia. 16.4 billion of premiums, 16 million lives covered, TPD, trauma, income protection. Some other interesting stats from APRA that they released with ASIC, and this gets to the core of the issue we now face with income protection. Income protection, individual advised, 66% is the percentage of premiums that are paid out in claims. And you think individual advised has a problem? Look at the direct market and the group market. 104% of group life income protection premiums are paid out in claims. It also, this diagram shows in the direct space, the payout ratio for death and TPD is also quite concerning. That's just too low. So we have on this page payout ratios that are too low and payout ratios that are too high. When you think about the premiums, the percentage of the premiums, if you allow roughly 30% of premiums to be made up of commissions, which is the conventional figure for level commissions, there is also the cost of administration. So how much is really available to pay in claims? And clearly 66% is too high a ratio. This next slide shows the percentage of claims that are admitted across each of the channels. Obviously, TPD is a lower ratio, and that's been something that has triggered research by ASIC. But if you have a look particularly at the direct market, 59% of TPD claims being paid out. It is a very good message for individual advised in death and income protection, and likewise in the group supermarket. Just a little reflection upon our Australian life insurance market. Unbelievable level of change that has happened over the last few years. Here's a listing of the largest 7 by market share across both individual and group and direct. With the sale of AMP to Resolution Life, only one of those 7, probably by this time next year, will be Australian owned. Also want to reflect on what investment trends said about the greatest concerns that advisors have. And it's interesting to see that a change in the cap or ending life insurance commissions was actually at the top of the list of concerns. So other concerns there around deducting fees from super platforms, the degree and exam requirements, and annual client opt-in obligations. So yes, grandfathered commissions coming 5th on that list, but life insurance commissions is a big concern for financial advisors. We have a lot to fight for to make sure that they are preserved when the ASIC review in 2021 is consulted on in 2022. Also want to provide a little bit of context around income protection. There's a lot of advisors who say, well, the LIF reforms were put through, all the life insurers have done is increase premiums since, the profits are just being returned back to the life insurers. Well, I'm going to present some data today that suggests that that's not actually how the market has turned out over the last few years. APRA came out in May to say that $2.5 billion had been lost in the individual income protection market in the last 5 years. We've also seen ASIC come out more recently and talk about the TPD market, expressing concerns about, in particular, activities of daily living and having a 60% decline rate for that type of cover, where a claim came down to those terms. ASIC are expecting significant changes happening in the TPD space. KPMG has released some analysis of the life insurance market recently, and they have said that in the first half of 2019, the industry actually made a loss of $86 million. The lump sum part of the market is profitable, but the income protection part of the market is losing a lot of money. It's interesting to contrast that with 2017, when KPMG suggested that life insurance made $1.5 billion. So then earlier this week, we had the announcement from APRA, and this is some fundamental changes to the life insurance market, that it's important that advisors understand this, understand what is being changed and the time frame that it's going to play out in. So APRA had issued a warning to the life insurance sector in May with respect to income protection. By Monday, they had come out and they are intervening. Now, what they're actually doing is they're introducing additional capital requirements for life insurers and reinsurers operating in the income protection space. So they are going to require them to have more capital. This will add to the cost of these products. Now, they can't naturally demand particular changes, but they are assessing how much capital will be required based upon how life insurers respond to their expectations. So we go through this. Income protection benefits will no longer be able to be issued on an agreed value basis from the 31st of March next year. And they're also saying that benefits should not exceed a policyholder's income, because they do not want perverse incentives for people to stay on income protection cover. They're also saying, now this is not till the 1st of July 2021, that policies would need to be for a period of no more than 5 years. So it would be fixed for 5 years. That fundamentally changes our existing market, which is guaranteed renewable, and as long as clients continue to pay the premiums, the cover stays in place. What they're saying is the term of the policy could only be for a maximum of 5 years, where clients would have the option to renew for further periods of no more than 5 years, based upon the terms and conditions that applied at that time. This opens up all sorts of questions for us as to what happens if they're on claim at that time. What are the other potential implications in terms of clients in these older products versus clients in the newer products? They've also expected that insurers will put in place effective controls to manage the risks associated with longer benefit periods. So these are some fundamental changes. It's very early days. We are at the moment looking through this. We are conscious that the key change will be that agreed value policies will disappear from the end of March next year. We're not sure what the outcome is going to be for those people who are self-employed, what the implications are there. we will have to play a part in the consultation that happens and consult more broadly with the insurers. But I think it's important that members understand that this change is happening. Clearly, it needed to happen because the market was simply unsustainable. We need to make sure that the income protection market is fixed so that Australian consumers will continue to have access to income protection cover into the future. As we know more about this, we will say more and keep members informed. So painting the picture, the overall picture of the life insurance marketplace, it is unprecedented challenges. We'll see a reduction in advisor numbers, continued reduction in advisor numbers. In the individual advised space, your space, we've got the review by ASIC in 2021 and the outcome in 2022. We've got the pressures on the economic viability of providing life insurance advice with things increasing costs, whether that's the FASEA Code or expectations about statements of advice. The direct market, huge pressure during the course of the Royal Commission. We've seen legal action taken with respect to hawking. ASIC has announced today that there will be a ban on unsolicited telephone sales. The group supermarket has also been through significant change, and we haven't seen the full impact on their numbers of the Protecting Your Super package or the upcoming Putting Members' Interests First opt-in requirements. This will have a significant impact on the level of cover through group super. And then we also know that income protection is an issue for the group market. We saw that 104% claims payout ratio, and ASIC is also looking very closely at TPD. So the life insurance market is going through a period of unprecedented challenge. Life insurers, I do want to give you a very positive message about the ASIC review in 2021. There's been no question that the life insurers have stepped in to support the continuation of risk commissions. So Zurich, MLC, Clearview, TAL and AIA have all been very vocal in their support for the continuation of commissions. And we all know very well that the removal of commissions in life insurance would have a decimating impact on Australians being able to access advice to get the best cover they can through the retail advised marketplace. The AFA is working closely with the FPA as part of a joint task force inclusive of a number of advisors as we work towards ensuring that commissions are retained when ASIC goes back to have a look at the quality of life insurance advice in 2021. This remains one of our absolute core priorities. Right, we are coming towards the end before we get over to questions. I just quickly want to cover off FDS and opt-in. ASIC have run a 12-month project looking at the compliance with the FDS and opt-in obligations. They looked at 30 licensees, 1,600 FDS cases, 573 opt-in notices, and they looked in some further detail at compliance with the requirements. 93% of cases FDSs were provided, although in 9% of cases they were provided late. With opt-in, the results were more concerning. 65% of cases they were provided, however 8% of those were provided late. Now, of the 176 FDSs that they looked at in detail, 80% didn't comply in terms of the requirement to disclose the services the client was entitled to receive. 73, they said the information on the services actually received was inaccurate, and 44% of the fees disclosed was inaccurate. There's a lot of issues in here that we are talking more about in our weekly newsletter this week, but this is going to be a continuing focus, and no doubt the outcome of this will be rolled out across more than the 30 licensees that were involved in it already. To conclude, before we get kicked off in the questions, we are very conscious, and one of the messages I get all the time is can you finish on an upbeat note? Well, and I'll try and do that. That we do believe that we have started to see some good progress on some of our issues this year. We've had the government commit to extend the deadlines for the FASEA exam and education requirements. We have had a response to our concerns around the Code of Ethics. We know that there are people in government that are very concerned about what's happening in the financial advice space. We've put a lot of effort into encouraging our members to talk to their local member, and we continue to encourage you to do that. And we think that that is paying off, and we will expect to see more benefits next year. But we know that that all this reform at the one time is really proving to be very challenging, and we know there's very high stress levels, there's a lot of anxiety. We encourage you to reach out if you are struggling. We encourage advisors to pay a very close interest in how their colleagues are travelling, so that people do find someone to talk to. And the AFA offers the AFA care service. We strongly encourage you to reach out if you are in a situation where you need help. Please, let's look after each other. Now, very quickly, know that there's a lot of stuff going on in your head. It is important to stay actively engaged in what is happening. The next opportunity will be at our roadshow in February. We've got a number of really good speakers lined up, including our award winners. This is being partnered with Challenger. It's a very good lineup, so strongly encourage you to come along. What we've done this year is with the help of Challenger, we've got a very competitive price. We just want to see as many people come along. It's important to stay engaged. It's important to continue to talk to people. It's important to know everything that is going on at the moment. So I'm now over to questions. And thank you, Lisa, for running through these. We can see that there's quite a few questions there.
So Steve, he's asked about referencing the falling rate of life sales, particularly during this period of uncertainty, and how Standard 3 will be supervised and policed.
So it's one of the things that's very clear is that new business volumes have declined significantly in the life insurance space, and that is a fundamental challenge to the life insurance market. In terms of Standard 3, my advice is quite clear. You cannot and do not need to stop charging a commission for life insurance. I think at the end of the day, the ASIC response about the facility of compliance approach means that as long as the advice is in the best interest of the client, and you can demonstrate that and you have the records to prove it, I'm certainly not encouraging anyone to move away from the receipt of life insurance commissions. I cannot be any clearer than that. We are not encouraging anyone to do that. It is just not practical. It is not in the best interests of clients, as long as you can demonstrate compliance with the best interest duty.
All right, so I've got one from Paul here. Is there any discussion around the definition of service and getting away from ASIC's strict interpretation that service is about an ROA or an SOA?
Yes, there is. As I said, we're producing a paper on annual renewal, which we'll release next week. In that, we're very much saying that it should depend upon what clients need. There are some clients who don't need a renewal, don't need a review. They want you to be there to answer questions. They want you to help them with dealing with Centrelink. As you look at older clients, they have different needs. We also have to have a look at all these grandfathered commission clients who will be transitioned over. The benefit that they got out of having access to an advisor was not necessarily dictated by having a review. This is something that we are certainly arguing for.
So Frank here, when supplying the FDS, could the opt-in be conducted at the same time?
Absolutely. So all we're saying, and look, this proposal that we're putting out there is for consultation. We need to move now because it's going to move, the legislation will move forward pretty quickly. But we're saying have greater flexibility. If you've got 8 months, between the 8-month mark and the 16-month mark, to sign the client up to continue the arrangement into the new year, then that gives greater flexibility and the FDS can happen at the same time. But what we don't want, at the moment, if you get a client to opt in early, you have to bring the FDS forward. And that means it resets the cycle for the new year. We don't want that complexity that comes with that. So if you're going to be providing, you're getting them to do opt-in later after the FDS is available, then great. But let's not bring FDS periods forward so that you can do opt-in early.
Okay, I've got another one here from Ron. How do insurers believe that massive premium increases for existing clients is going to solve their problem? All that is happening is healthy clients are cancelling while sick people leave, therefore less premiums for a sicker book.
Look, I think this is a very good question. We're very conscious that in the life insurance market, discounts have been introduced for new policies, whilst at the same time premiums are increasing for existing clients. The life insurance market is obviously under a lot of pressure at the moment. New business volumes are down. We have to find sensible solutions to these issues. Really good question, and I can read that the APRA announcement did not say that at the time of the renewal of a 5-year arrangement or new rollover of the existing cover that underwriting would be required. It was simply that at the end of the period, there was an option to renew, but it would be on the terms and conditions that applied at that time. So no, underwriting would not be required. There's all sorts of questions about, well, what does it mean for someone who's already on claim at that time? And we'll just have to wait and see how that plays out. A question here about whether these changes will force churning. We don't like the use of the word churning. Churning is inappropriate product replacement. It may well be that some of the changes happening at the moment do mean that it is in the best interest of the client to change the cover. Where it's in the best interest of the client, then you are duty bound to act in the best interest of the client. It's not churning.
So with respect to the changes to insurance suggested by APRA, are similar changes happening overseas?
A really good question. I don't think I'm the best expert to talk about that, but this 5-year fixed term cover is to some extent reflective of the market in the UK, where they don't have guaranteed renewable as we have here. I think this reflects some issues around our market, the form of insurance that's available in our market. I think that we need to be very cognizant of what's happening in the rest of the world, but I think this is more a reflection on our market than it is on the rest of the world.
So with regard to the APRA insurance recommendations, do you think these potential changes will affect existing insurance policies, or will these existing policies be grandfathered, agreed value, guaranteed, renewable, etc.?
So there's two parts to that question. Are the existing policies going to be grandfathered? Yes, they are. This is about APRA's expectations And it's not actually setting the law, they're just saying that the capital requirements for life insurers will be influenced by the extent to which they comply with APRA's expectations. So it will be with respect to new policies. The first part of the question is, do we expect this to impact existing clients? And the one thing that we are very conscious of is that existing clients are going to be potentially more exposed to premium increases because these are the clients where the existing terms and conditions cannot be changed. So the policies will be grandfathered, but we need to be aware that premium increases could well flow. And as we understand it, and as you look at the stats on income protection, it's difficult to see that insurers won't be looking to increase premiums whilst this business remains unprofitable.
Have there been any developments with regards to Royal Commission recommendations that claims to be treated as a financial service and recommendation for the rollback of Section 29(3), i.e. 3-year innocent non-disclosure rules?
Yeah, Peter, the treatment of claims handling as a financial service, if I'm not mistaken, we have consultation papers issued earlier this week. I haven't got to it yet, but it looks like that has progressed. The government had already consulted on that, and it seems like we have some draft legislation that's available. Peter, I haven't followed the 3-year innocent non-disclosure rule. I don't think I've seen anything on that yet, so I would have to go back and check that, but I don't believe that's come through yet. I think we've gone a little over time, but look, I'm happy that that we will stay on the line for a few more minutes for those who've got further questions. What I do want to say is that the attendance today is entitled to CPD points. So we will be doing an assessment of people who stayed on the line, and we still have nearly 250 people on the line. So very much thank you for staying on the line and participating in this. I hope that you've found it useful. There is so much going on at the moment. There's so much recent change. We've necessarily needed to focus on only a certain number of issues in the time that we've had available. Once again, we will going to stay on, but if I could, for those who do want to leave, I'd just like to thank you for your continuing active involvement with the AFA, your continuing interest in the policy announcements and our regulatory advocacy activity. We want you to continue to stay involved. We want you to continue to keep advocating with your local members. We want you also to work with your colleagues in doing that. But last message is keep an eye out for people. We will find a way through what's going on at the moment. It will stay challenging, but keep an eye out for colleagues and make sure that you are all in a good space to move forward into the challenges of next year. And I wish you a very happy break at the end of the year. Refresh your batteries, get set for another big year next year. So for those who want to go, you will get 1.25 hours of CPD, but those who want to stay will continue answering some of the questions. So thank you very much. Back to you, Lisa.
All right. Is there anything else we as advisors need to be doing, talking to politicians, etc.?
Yeah, look, I think that it is important to build those relationships with politicians. You know, it's like they are the ones that make the rules that influence your profession. Advisors are great relationship management people. You know how to build relationships, you know how to maintain relationships. You got to recognise that politicians are just so key. And we've seen this year that the more we had the opportunity to build relationships with politicians, the more likely they were to take an interest in our issues and ask questions where they had the opportunity to do that. So I'd encourage you to keep actively involved in that. What we need to say is go there with realistic expectations, treat the politicians with respect, do it with the objective of building a continuing relationship.
Okay, good another one here. Can I still continue to provide my FDSs in November to all FDS clients and provide the opt-in every 2 years of the date of sign-up?
So if your practice is to issue FDSs in November, then absolutely go right ahead. Keep in mind that, as I said before, anytime you issue an opt-in notice, you have to give an FDS at the same time. Opt-in stays every second year until the law is passed. So what I'm saying is that these changes are being worked on at the moment. The law may change by the middle of next year, but until it's changed, you don't need to do anything different. Obviously, listen to what your licensee is saying. Some licensees are already wanting to move advisors to a 12-month arrangement, and they're doing that because a 12-month arrangement is, so 12 months no more, is not classified as an ongoing fee arrangement, and therefore FDS and opt-in is arguably not required. But you cannot go one day beyond 12 months if that's the arrangement you have in place.
All right. So any sense of how these changes will impact PI premiums?
So I think the intent of this is to provide a policy that is not as expensive. But as I said before, the market at the moment is unprofitable, so you can only assume that further increases will come through. Hopefully, to some extent, we'll get to a balancing point where the changes to the policy design leads to either stopping the increases or at least reducing them.
Okay, we've got a number of questions here about the slides and the recording of the webinar. So these will be made available and they'll be uploaded onto our website in about a week's time. So that's...
All right, so have we covered all questions? Most questions? Yep. Okay. We've now got a few less people on the line. So let me just sum up again. Any questions that come out of today, please call the office or email us at policy@afa.asn.au. Thank you very much for participating in the webinar today. Thank you for those who stayed on for extra time. I wish you a very good break and a fantastic Christmas and New Year. Thank you, everyone.